Welcome to Fintech 2021, a virtual conference by FinBlue, a fintech center of excellence set up by the Software Technology Parks of India. FinBlue is an initiative to provide resources such as mentoring, technology support, and funding for fintech startups. Naturally, the next stage for startups that emerge from such a program is to scale up, and that is where venture capital comes in. As one of the most thoughtful investors in the Indian startup ecosystem, I look forward to hearing from Vishesh Rajaram, managing partner of Speciale Invest, on the topic venture capital funding in the new normal. And post his short talk, we will have a follow-up interaction. Over to you, Vishesh.
Thank you, Arun. Thank you so much for having me here today to share my learnings and my views of what's really transpired in the last 12 months and what the outlook is going forward. And before I start, I take the opportunity to talk a little bit about the firm. I'm one of the two co-founders at Speciale Invest. We're a seed stage fund. We typically invest about $500,000 in check sizes. We invest in companies that have vintage of less than a few hundred days old, typically companies that are pre-revenue or pre-product market fit, or even in an idea stage. In terms of our focus, we're largely focused on two broad categories. One is enterprise software, where we particularly look for companies that are building software products out of India for global markets, primarily North America and Europe. And the other category we look for within enterprise software is building tools and products for the large 20 million plus developer ecosystem that's there all over the world. The other large category where we invest a lot of time learning and investing is frontier tech hardware, where we largely look at broad categories such as opportunities in space, opportunity in additive manufacturing, opportunity in batteries, opportunities in climate tech. And these are essentially building technologies of the future. These are building technologies that are more relevant now that didn't exist before. So that's largely the focus. We have about $40 million across two funds or two vehicles that we're investing out of. We've done about a dozen investments. It's almost 50-50 between enterprise software and industrial hardware in terms of focus of what we've done. If anybody wants to reach us, our website has email IDs and coordinates for you to write to us. We strive hard to write to every email that comes in our way. In terms of just the question that's on our minds on, hey, what the outlook for venture capital or what the outlook for startups is going forward in the new normal, I think a good starting point is to rewind 12 months back and really see what transpired, right? And the last 12 months have essentially been accelerated learning for all of us. Every time an event like this comes, we essentially go back, look at historical data, look at what's happened back then, and try and accommodate or accustom ourselves to data around that. And it's surprising to note that the last 12 months has been unbelievably different. You saw listed markets go through an all-time fall, and now you're seeing them at an all-time high, all within a 12-month period, right? So I remember this. I was interviewed by, I think, one of the big one of the magazines in March, April of 2020, and the view I had back then was there is going to be a flight to quality, which means investors will do fewer deals. Investors will put more money in the few high quality companies. And I think the view I had at that point of time was that early stage investment will possibly drop significantly. And that view essentially came from looking at what happened in the year 2008, 2010, when we had the financial crisis. And to a large extent, I think till about June or July, that's what played out, right? Most VCs were essentially looking at their portfolio, including ourselves, to essentially do impact assessment, planning, rejigging, recalibrating, and making sure that there's enough money for the existing portfolio. But the big difference between 2008 and 2020 was that the underlying economic factors or financial markets didn't take a big beating. There was still a lot of dry powder in the VC community. The financial markets still had a lot of liquidity. The fiscals did not take a big beating. And as a result, I think the later part of the last year saw a fairly quick and unexpected rebound, just given people's ability to have liquidity to come back and do transactions. And I think the later part of 2020, one possibly saw transactions back to earlier levels. And VCs had a lot more dry powder out, and people started realizing that this may be good times to start building companies in the new normal, because now you have new trends. There is a change in consumer behavior, there's a change in corporate behavior, there's a change in human behavior, and that therefore creates an opportunity to go and build out new companies or new businesses that didn't exist before or didn't have a need to exist before, right? And along those lines, you've seen a lot more transactions that have then picked up, and I think Jan's also been a good month in terms of just the number of transactions we're reading of other VCs doing, and so on and so forth. I think particularly commenting on what's in the new normal, a lot of this is very much based on just how consumer behavior is in this year, right? And there is, of course, there is a vaccine that's coming out, and people will wait and watch through Q1 on how it's being rolled out and its efficacy of it. And I think that will have a great underpinning on how some of the real world businesses, physical businesses, will play their growth out. And that also has a very direct implication on how some of these more new normal online businesses, primarily around education, around remote work, and remote management, all will also play out. As a betting man, my guess is some of what we do on a normal day-to-day will go back to old ways, but I think a large piece of how most of us will run life will be possibly different from how we ran before. Speaking for myself, I used to sort of straddle two cities. I spent half the week in Bangalore and half the week in Chennai. Now I spend the entire week in front of Zoom. Am I going to be living life drastically different 6-9 months from now? Unlikely. I think the world is now starting to accept that you don't need to be physically there for all meetings or for all activities, and there is a good chunk of the world that will continue to operate in the new normal, and a good chunk of these new businesses that have now come into existence in the last 6 to 12 months will continue to thrive. And I think that's where the future lies. The other element on specifically what we look out for, right? I mean, we do a reasonable part of our fund to sort of back technologies of the future, technologies that didn't exist before. So I think climate tech is going to be big. It's very nice to note that the number one or the number two richest man in the world today has got businesses that's helping human beings buy more time on Earth. And I think that's the future. Buying more time on Earth and living longer, and opportunities coming out of that is what's going to buy more wealth or create more wealth. And that will also see some acceleration than ever before. And we're quite excited because we've got a few investments in some of those adjacent areas, and we're excited going forward.
Thank you so much. That was a fantastic overview of how things have changed and how things have not changed as well, right? So some fundamentals are going to remain. Very excited. Given that the theme for this conference is specifically on fintech, it's like you said, been a very interesting year, especially in the second half of the year. Things changed quite a bit, on the funding side of things. So much so that fintech, if you take overall venture capital, was the second most favorite among investors. This includes even growth investors after e-commerce, right? So it's an obvious beneficiary because of, all the pandemic and so on. And then, you had, if you slice the early stage, which is like your less than 5-year-old companies receiving, less than, let's say, $5-10 million, even there, fintech followed SaaS as the second, favorite sector for early stage investors, including Speciale and others like yourself, right? So, what do you see, obviously fintech starting with Paytm has been around gathering momentum even before the pandemic. What do you think has changed in the landscape, that specifically attracted, investors like yourselves or maybe even in general to the fintech space?
So I think firstly, financial services before it became fintech is a very large business with a large market, and with a population size such as ours, it's possibly the more one of the more integral parts of the economy, and hence is always a growing market, right? And financial technology is an extension of financial services that allows you to do things very differently, collect data on customers, access customers more simply, and provide ease of convenience and access, right? And that's what largely fintech is. So I think it's clearly its growth possibly for the next many years is going to be phenomenal, very high, and at some point may even exceed or shadow e-commerce. Just given that it's got there's a B2B aspect to it. It's got about how enterprises are getting finance. It's got about how consumers are using finance, and just how large a consumption economy we are now becoming, or at least the metros are becoming. These are going to be very large pockets and very large markets, and you will continue to see money being pumped or money being invested in these categories, right? um, what's What's also interesting to see is you have insurance also coming in under the category of financial services. Insurance penetration is continues to be a very small percentage as a percentage of the population. And again, the insurance inclusion, just like how financial inclusion, those are opportunities to then sort of go out and build in different shapes and forms. I think the base level of financial tech is going to be just getting access, and then you start curating and cutting and making new products and or giving new offerings once access itself is solved. And fintech, I think the access problem is largely opened up, and now you're going to be looking at interesting opportunities in giving new products and new services, segmenting customers to seeing what each one wants, and slowly and steadily evolving to mass customization, which means you open your banking app, it's going to be looking very differently to you. If my son opens it, it'll be very different for him vis-a-vis what it is for me.
Absolutely, very interesting. And in some of your own portfolio companies, you have what, 11 to 13 of them announced formally. Is there a fintech flavor to any of them, including as users, our banks, for example, customers of some of them? Is there anything that you saw changing during 2020 with those?
In full honesty, we've looked at a few companies, came very close to investing, but for various reasons didn't go ahead. So we don't have anything in the active portfolio that's got a financial technology underlying to it. But that's a sector where we've got a lot of anti-portfolios.
Okay.
That's a sector that we continue to look at quite actively, just noting how well some of the anti-portfolios have done. So I'm very self-reflective on this sector.
No. So if you can actually name some names, if not, that at least give us what would you have liked to invest
about it. And there's a pun intended there. Our biggest anti-portfolio in fintech is the Open Bank company. We looked at them when they just closed their pre-seed or their angel round, and we came very close to completing the transaction, and it didn't happen. And we're very happy on how they've done. And we thought that they had a very interesting way to solve a problem for new age businesses back then when they just started. And clearly they've evolved and grown phenomenally well from just that, one single pain point that they were looking at back then to how they've now an open bank as I see them, and that's one where the need or the problem statement they were going after was new, was unconventional, and was essentially going after these newer businesses that have small transactions and large number of small transactions, right? And a traditional bank and the traditional bank's model didn't necessarily tune or build itself for that. A bank software was built for the bank, right? It was not built for the customer. But today, we're now evolving ourselves to saying, hey, how can I build the bank software that's capturing the fundamentals of what's needed for the bank, but also makes it simple for the customer? And I think Open started with that fundamental aim and has now phenomenally grown and will continue to be one of our top quartile anti-portfolios.
Interesting. So given, Speciale's clear focused approach, right? So what kind of, fintech companies do you think, should approach you? Is there a core IP that you require? So you gave the example of Open, but, if any other companies, is there a point where you feel that the IP is not enough and therefore, it doesn't fit your thesis? Or is there something else? So what kind of broadly fintech companies should look at Speciale?
So our definition of IP is essentially a combination of founder insights and or market insights and or technology or engineering insights. And this collective allows you to do something which is hard for others to catch up, right? And those are the kind of companies that we like. Clearly, if you looked at Open, the founders' insights of that particular pain point and their engineering capability to go build a complex solution that interfaces into traditional core banking modules and function was quite phenomenal. And while that's not IP in the traditional sense, it's very much IP in the way I look at how Speciale looks at investing, right? At the same time, we're a seed fund. We invest in seed. So we're reasonably cognizant of our ability to participate in size in multiple rounds, and hence we're wary of businesses that need large chunks of money to go build an NBFC, right? So if you're in the lending side, clearly we're not the best partners. But if you're on the software product or the software tool side or the sandbox side or the API side, then it just makes a lot of sense for us because we fundamentally believe in going and building a product that can be sold multiple times at high gross margins. Those are learnings we've had from our SaaS businesses, right? Or from our hardware businesses. Build once, go sell multiple times, get insights, go build, scale up from there. So those kind of businesses, I think we may be a good fit and would always love to talk to entrepreneurs building those.
Fantastic. Given that FinBlue is taking off, what would you think are the kind of polishing that incubator or accelerator like FinBlue can do by the time they reach out to a fund like Speciale? So in your experience in working with other accelerators and so on, what do you think can be the value add from those folks to help make those better polished startups by the time they reach you?
I think by the time you typically are reaching a pre-seed or a seed fund, the investor wants to learn what is the insight coming out of this business, right? And like I bucketed them, I think it'll be great in the storytelling for investors to hear what is the founder's unique insight? What do they know about this business, which is unique to their past experience, right? What I think of it as founder market fit. Then what's interesting is particular to this fintech business, hey, in this limited time that you've possibly built the product or launched the product, what have you learned from the customer? What is the need? What is the pain point that is there? And is there some evidence of that pain point that you can display to investor? And if you've actually launched the product, the proof is finally in customer adoption, right? And of course, each one has a view on what is scale and what is traction and all of those words. But at the base level, I just want to know what is the insight for this business to be built or this product to be built, and what is the proof point for it. And if there's a way to channelize that, I think that's great. Because the metrics are in it's each one to their flavor, right? I mean, if I'm pre-seed, then I'm okay with something. If I'm seed, so it's hard to put the number, but it's very useful to just for someone to simply say, hey, I'm building this because this is what I know, and this is quite unique to me because this is my past, and these are the customers who've told me this, and here are the proof points.
Correct. So, clearly FinTech has been one of the sectors, with tailwind thanks to the pandemic, like we discussed. Uh, but, when we're talking about a vaccine now and, when it comes to education, back to school and all of that. So, we saw this during demonetization also briefly, right? So there is a very heavy impact event, and then people go back to what they were doing earlier. And Peter said that a lot of cash is back, post demon. So people say that once schools are open, a lot of the edtech, which is the flavor of town, might kind of come down a bit. So do you see on the financial technology side any impact of back to normal, being, for example, a negative for the sector? Is there something like, is it permanent, semi-permanent? Do you see something that entrepreneurs should watch out for without overextending, for example?
So fintech has many facets to it, right? There's a lending facet to it, which I think people are already treading with caution because you need to understand who you're lending to, what customer profiles, and what they're underpinning and under finances, and so on and so forth. And that's a complicated territory to operate. Some areas are fine, some areas are not, and I think people will generally be watchful. And to some extent, the macros have their impacts on it, right? And I think depending on the vaccine and depending on when retail or physical retail opens up and so on and so forth, a large piece of that will have its impact in a positive way, hopefully. I think the worst is possibly over for them in a positive way. Now, there is the other side of it where you've got all these people who have money or who have liquidity or whose jobs are stable, who are now having the advantage of accessing financial services sitting where they are, be it home or office, right? And they are unlikely to go back to the old way of doing things because they've gotten used to a way of that's operating for them and that's working fine. Now, that's still a very small number and that's a growing number. I don't think we've come where 90% of the population is using, and are we worried about losing 30 of the 90, right? We're still a very small number and only growing. So accessing all of that, I think it will continue to. I'm speaking largely for myself, right?
Yeah.
And I'd like to assume that it's going to continue to be the new normal, and people don't necessarily want to meet a lot of people before they make certain decisions on investing in small numbers, or even borrowing, or even opening an account. I think people would want to just do it sitting where they are. Less because of the worry of COVID, more because I think they just enjoy the convenience that has come out of it, right? It's like, what did e-commerce really do? E-commerce just allowed you to sit where you are and shop. And pre and post COVID, people do that. The guys who did pre-COVID do it post COVID, right? Or during COVID. And that's not going to change because that's just giving you a new convenience of how you use your time and what you do with, irrespective of where you are. And that's not going to change.
No, fair enough. Now if your bottled water guy takes 40 rupees on GPay, and he has no cost, why would he go back to cash, and why would we hunt around for the 20 bucks, 40 bucks, whatever, right? So, yeah, well, very well put. Interesting. From an investor perspective, if you look at financial services and then, look at it from an exit, at the end of the day, venture capital is a business, of exiting. We've seen a lot of unicorns get established in the fintech space, obviously starting with Paytm. And, in terms of exits, we have strategic investors acquiring companies in the payment space largely, right? Citrus, Paysends, you had Freecharge and you had Quicksilver. All of them either got acquired by, other fintech, larger fintech companies, or they had their stakes acquired by private equity and so on. So broadly speaking, from an exit standpoint, fintech seems to be in a good spot. A lot of big players there. When it comes to earlier stage, and you touched upon insure tech, for example, we don't have too many exits. Policy Bazaar has started to grow big and so on. They have some secondary exits. Where are you kind of thinking that beyond payments broadly, and then within exits, opportunities that investors would look at?
So I'll take the exits part first, and then I'll come back to opportunities to invest. Right? I think um, the one exit that we've historically seen less in startups is public markets. Because traditionally, public markets have looked for stability, vintage, and cash flow. And traditional finance also supports that line of thinking that you have cash flow, you have positive cash flow, and you support. But I think with the way some of the other markets, specifically the Western markets, operate, where there is a view, there's a stability in growth, and there is clarity that at a certain scale, the free cash flows make up for the short to medium term burns, those kind of companies can possibly access public markets. And there have been conversations specific to the Indian markets being reflective to allow for some of these flexibilities and allow for some of these grown up startups to go out and list. And I think that will be interesting because there is an increasing percentage of retail investors that also understand tech and the newer businesses that may not be making money in the short term, that may have the potential, right? And I think that's an unaccessed market. And I'd like to believe that's growing and large. And that could be something we haven't seen, and that may just play out very well. As far as opportunities in fintech, like I sort of qualified upfront, we look for products that can be used repeatedly, that gives you margins. We're cognizant that fintech is a spread business, right? If you're lending, you're borrowing from somebody in lending, or you're getting deposits in lending, and hence it's a spread business. So we know that largely the margins are not huge, and hence at volumes it makes sense. So I think we are excited about opportunities now around investing, brokerages, exchanges. Some of those look interesting because that's doing what it did to just accessing banking before, now accessing markets to people. And the retail audience is increasingly becoming more affluent, more aware, more informed. And I think a lot more people will look at these avenues for creating wealth in the medium term. And that's an area that we sort of continue to look out for. We're also seeing a trend wherein population wants to be truly global and hence wants to access opportunities not only here but all over. And then technology products that allows you to access financial products in different parts of the world is also looking to be very interesting and large. That's particularly an area that we're spending time at to understand the frameworks on the regulation side, on the consumer patterns, to see if there are opportunities to go and build out.
Reading between the lines, from what you've just said, if you slice the, let's say, a company should potentially be able to IPO in the domestic markets is a nice scenario to have. Is there a B2B versus B2C flavor, when it comes to potential IPOs, right? So unit economics are going to be crucial in Indian markets, especially don't support, like you said, too much negative cash flows and so on. But is there an advantage, therefore, automatically that we will see more, domestic exits and IPOs included coming from the B2B side, or not necessary?
I think in the short term, the B2B side has a better chance, right? If you look at BillDesk, for example, they're a large company, cash flow positive, grown very frugally, very steadily from when they started, right? And those companies are prime for IPOs if they do go that direction. But the advantage B2C brings always is just scale and market opportunity, right? So I wouldn't rule that out. Conservative wisdom and historical trends may not be batting for it. But now that we're talking new normal, there's a great chance that some of those may come because the scale at which they operate is quite large. And sometimes when you cross the tipping scale, free cash flows start coming in.
Very interesting. One of the key developments, 2020, was, the India-China equation, so we saw a lot of, the last 5 years, a lot of Chinese investors come and become follow-on investors to early stage investors like yourselves. Now that has almost gone away, we don't know how that will change, but the reality is that we have gotten relinked to the US in that sense, so the pre-placements for the Chinese investors, are typically the follow-on bigger guys have become the US all over again. So what do you think about, your reading of this geopolitical scenario, relinking to the US versus losing some of these Chinese investors? So what is your reading of this whole, US-China equation?
So it's complicated if I get into the details. I think there is going to be an increasing push for everybody to aim for localization, and that's coming out of desire for higher level of self-security of where the information sits, who's doing what. Just the fear of the unknown of who can do what with it will force people to think a little inward for good reasons, I would think. Right? And that will play out in many aspects, especially if it's involving consumers of India, which essentially means the underlying data of what consumers do with it. Where is my house? Where's my office? Where am I going every day? What am I doing? Where am I spending? All very important information. Right? So I think there will be some sensitivity to it attached to just the security that it carries along with it. And I think for good reasons, the way we are approaching it is possibly appropriate for the time and era we are in right now. And as far capital is concerned, people with wealth have to create more wealth. Number one. Number two, certain geographies will continue to grow and expand. The GDP numbers matters less. To me, the relative growth of one's own country vis-a-vis other country matters more, right? So if there's wealth sitting in some part of the world that needs to grow, India clearly has an allocation, right? And I think that's all we need to look at to make sure that we get the right partners, right allocation, and go out and build wealth. And create value in India as well, jobs, taxes, infrastructure, all of that. And as long as that's being done, I think we should be fine.
Interesting. So, speaking of 2020, we really can't escape, the geo phenomenon, right? So, given including once they're done with their massive fundraisers, they went out and acquired some startups, Urban Ladder, NetMeds, and so on. What is your take on what geo's moves are, and what should VCs and entrepreneurs, do to factor in this, phenomenon?
Great question. I'm almost thinking twice on how to answer that. But I think if I were to summarize it in a very simple form, VCs and founders have to be very realistic of staying power, unit economics, and ability to spend capital to build businesses that at least turn profitable sooner than before. Because the same customer, the same trend, you've got now a very large balance sheet investor who has more operating experience and more understanding of India than most other people. So whatever you do, you do it being more realistic. That's my suggestion. Of course, we have very little experience on the consumer side, so I'm cognizant of that as well. But stepping back and noting that they're going after some of these big opportunities in kirana, in retail, in fashion, in education, and all of that, I think one has to be cautious and how they build these companies if you're a startup with less capital.
Interestingly, fintech is not yet a space that they have done any big move in. So that's probably something that's to be kept in mind by this audience.
I don't know. I don't know enough to comment.
Fair enough, yeah. So one of the interesting things about 2020 was that angel investments and hit a 5-year high. So something like 340 plus investments by just the angel networks and the super angels as they are called. And what and obviously seed funding also had a surge like you talked about at the beginning. That was a bit unexpected. The way middle of the pandemic. What were some of the factors that led to the surge, towards the end of the year? And more importantly, do you see it being sustained?
So I think there are many things that have gone into it, right? I've always seen slides such as, hey, in 2009, 10, 11, the companies that started have been the biggest companies now, which clearly meant it was basically rewiring everybody's mind to say it's a great time to start a company, it's a great time to invest in a company, it's a great time to go deploy capital, right? So I'm sure some of that drove it. I'm sure some of the clarity on these the AIF ones or the funds that Let's Venture or AngelList or some of them run, that essentially has now made it easy for a solo GP to go put a fund or create a syndicate and go build out, right? And clarity on that, ease of operation on that possibly has also opened up access for more solo GPs to go and build out some of these funds. That's clearly been another driver, I guess. Plus, I think the pandemic also opened up potential for new acceleration or new trends that lots of people could go out and build, right? Be it edutech. Edutech is an obvious one where you had so many of these new opportunities coming out because they know that people are going to be locked in for a certain period of time, and this is a great time to inculcate or build a certain habit. And if that continues, then you have a customer. So some of that, I think all three, a combination of, I don't know if I should call it FOMO, but combination of feeling that this is a great time to go build and create value, regulatory clarity, smoothness in operation, of course, liquidity being there, and newer trends that are now accelerated possibly led to it. Now, will it sustain? Largely everything has to be self-sustaining, which means you have to see some big exits coming out. And you mentioned a few people that have had secondaries and possibly having IPOs, and some of that will put money back in the hands of investors for them to have confidence to come back up. So, I'm hoping some of it will continue, whether it's exactly the same numbers, same growth rates. It's anybody's guess, but I think more of this will happen, and it's good for the ecosystem.
Absolutely. One of the things now it's a bit more clear, like earlier, some of the larger venture firms used to do seed programs and enter into areas that are typically, what used to be angel, now that is probably getting more clarity. So would you agree with that?
Actually, I think the top 5-6 funds are clearly multi-stage. They operate very early stage, they operate late stage, right? And a few funds have actually come out to saying that they have programs, like Axel has his rebound program, they have a founder stack program, Sequoia clearly has Surge. I think IDG recently announced something for Frontier Tech or Deep Tech. So I think everybody is not dismissing the fact that seed is a great time to identify back founders and create value. There is risk, but there is risk in everything in venture, right? So it's illiquid at the end of the day. So I think seed or early stage continues to be a great asset class that's generating value. And I wouldn't be surprised if more funds tend to sort of come and operate in that segment in some way, shape, and form to sort of create that deal flow pipeline to do more of it. And I'm sure there will be more people like us as well emerging that want to do seed-only funds, at least begin to do seed-only funds. And I think there will be some competition or more competition in this category. And then folks like us will, of course, we don't do everything in seed. We do a few specific things in seed. We look for deep tech or we look for frontier tech. And some of us may just continue to operate in just that smaller focus groups. focus areas, if I can call it.
Fair enough. So as we are reached the end of the session, the final question to you is in the form of common mistakes that you've seen in your venture career that startups make either that could end a company itself or at least end the conversation with a venture firm like you or rather a deal killer as I put it. Could you highlight some of those mistakes that entrepreneurs should avoid?
I think the biggest is expectation management. And that expectation management is with the self and with your partner both. Right? And if I were to peel that further, then it goes down into really, you have the runway, do you have the cash flow? Are you growing at the right speed? Are you spending the right amount of money? Because largely for most startups, it's about surviving long enough and doing a few things right. If you survive long enough and do a few things right, you'll be fine. But it's a question of surviving, which essentially means, are you burning enough? Are you burning enough for the right metrics? Are you spending enough for the right metrics? Is that allowing you to go get more capital from your partners to continue to grow in a certain direction? And all of that is hugely linked to expectation setting, expectation management. And sometimes we're all humans, we all make our own mistakes in either overestimating or underestimating things or not seeing things clearly. And I think that oftentimes just leads to downfall.
Thank you so much, Vishesh. I think a lot of what you said, applies not just to fintech, but across the board as well. And entrepreneurs would do very well to heed some of this advice. Thanks again. And thanks for the TIE and FinBlue for the opportunity to make this.
Well, that's very humble of you. Thanks for having me and, allowing me to share my learning. Thank you very much.